everyone, Ben Nelson here. Hope you're having a fantastic day. It is time for another market update because there's a lot going on in the market. Or maybe there's less going on than there was. I don't know. It depends on how you look at it. It is not nearly as busy as it was, 6 months ago. And actually, that's not necessarily true. It's still very busy. As a real estate agent, it's just it's very different. So we're doing, instead of managing 10 12 offers on a listing, we're doing a lot more marketing and a lot more promoting of listings, and a lot more of trying to do the things necessary to bring buyers in, instead of just you could throw up a listing and you had to manage all those offers, but you didn't really have to do a lot to bring a buyer to the table. You had to manage a lot of buyers coming to the table, and a lot of showings, and a lot of calls, and a lot of things like that. But you didn't really have to do the marketing side of it. So it's still very busy. It's just in a very different way, and you have to get a little bit more creative on what you're doing. So we are going to jump into the market, and I'm just going to hit some key kind of highlight things here. Again, that's kind of the point of these, is it's going to be a little different every time. But just to kind of get updated on what's going on in the market, make sure we're staying on top of what's happening, what to expect going forward. Once a month is not enough to do that with how fast things are changing right now. And like I said in my first one, I am not in the content creation business. I am in the real estate business. And so I just don't have time to do, fancy, really flashy updates, every couple of days. That's just not what I have time for. So I definitely want to keep everyone updated. I want to keep doing, informative market updates and things like that. Check out my podcast if you haven't done that. I do as much as I can, but the flashy stuff every day, I just, I don't have the time to do that. Other people maybe do. Maybe they're better at time management. I don't know. Anyway, let's jump into it here. I'm going to zoom this in here. I just wanted to point to a couple things. So all of these are around what's going to happen to house prices, because that is the big question right now. And I've been very bullish on the real estate market as we have headed into some a shift in the market as interest rates were going up. Back in May and June and July, I still was really positive about the market, and I still am long term. I didn't see a lot of pullback happening in the market with where we were then. Well, I said the caveat to that. If you go back and listen, the caveat to that, I always mentioned was, where's that threshold of interest rates? And every market's going to be different, right? So I think that's what we're seeing now, is that there is obviously an affordability threshold with interest rates. They can only get to a certain point where people can't make that payment anymore unless house prices come down. And again, it's going to be regional, based on what the local jobs are, what the local incomes are, and can they support those higher interest rates. So I've said all of that stuff in the past. I didn't necessarily know. I mean, nobody knew exactly where interest rates were going to get to. We're hovering right around 7%, mid sixes, upper 6s to 7% for your 30-year fixed products. And I think you're on the investor loans, a lot of, you're 7.5% to 8.5% on some investor loans. So definitely a lot higher than they were 6 or 8 months ago, beginning of the year into spring. So obviously we're seeing some pullback. Now, the interesting thing is, so these are all great articles. These are ones I just grabbed the links for real quick. Housing markets could push home prices down 20% in major markets like Dallas and Los Angeles. So again, you want to look at your local, because this is, if you just read the first part, housing markets could push home prices down 20%. You think that's nationally. Well, there's going to be markets that's true for, and there's going to be markets that it's not true for. See, and then his is case in point. Housing economists home prices to move sideways as Fed boosts rates. So that's more of a projection of prices just continuing to be staying sideways. 20 housing markets were overvalued by more than 50%. So that would be obviously a much bigger pullback than the 20%. And then this other one that just came out, This is Moody's Analytics data, and they're saying, they have 210 bubbly housing markets that could crash 25 to 30%. That's obviously a very big pullback as well. I believe 27 to 30%. I think that's what the average was in the 2006 2012 range of the financial crisis. So I'm not saying I'm changing my tune. I'm not going to say that, but yeah, I mean, the market's definitely it's feeling it. It's feeling the 7% interest rates. There's mortgage demand is way down. The thing is that we are so short on housing units. It's going to be really interesting to see how this plays out, because rents have peaked in a lot of places. Rents are leveling off. Now people are pulling back on buying houses. Builders are pulling back on building. So, we're going to see this additional continued constraint on supply. And, in the end, that is going to be a positive in the sense of upward pressure on pricing. Now, I'm not saying that will offset interest rates, but I am saying that at some point there's going to be this pent up demand. Now, they're calling for, let's look at what the Fed's doing, and you look at what's going on. And again, not to go down a rabbit trail, but the Fed funds rate is not directly connected to mortgage rates, although there is some correlation there. We won't get into the complications of that, but go back and listen to my podcast with Grant Schroeder. He gets into a little bit about how that works. Definitely something to understand, but just looking forward, if we do see higher mortgage rates longer term, and we see a lot of what's going on here with pulling back on producing new inventory because people aren't buying, all we're really doing, in my opinion, is we're going to kick that can. Now, we're really good at that. We kicked the can down with the economy. Now we're going to kick the can down the road a little bit with inventory and our inventory problems. And so what is that going to do? We might be okay for, just a year or so as things kind of try to figure themselves out in this new interest rate environment. But eventually we're going to have to get back to, building houses and providing inventory, and, rents may level out for a little bit, but if we're, and same with house prices, but if we're really short on inventory by as much as they say we are, then that is going to propel people into, it's going to propel house prices back up again, and it's going to propel rental rates back up again. And even if it's not right away, once rates do pull back a little bit, then the floodgates are going to open again, and we're going to see maybe not exactly what we saw with how crazy things got during COVID, but a pretty steady, strong market again when we get back to the rates coming down a little bit. Now, I don't know when that's going to be, but I don't, it's probably they're probably going to be 6.5%, 7% over the next year or so is my guess. One thing I did want to point out here. So this is really important to pay attention to, because I didn't pull it on here. Actually, I think this article on Fortune with the markets that could come down 25 to 30%. That one, if you go into it, it does show, let's see if I can actually just do it really quick. It's not shared, so I'm going to have to ad lib here and figure out how to do it. Okay, this is what I was looking for, was the markets that have increased inventory. If you go to that article about Fortune or on fortune.com and look at this article, it shows which markets, it shows a nice graph here of overvalued markets according to Moody's, and their increase in inventory over the last 6 months. And there's some markets that have increased significantly, and Austin is one of them. It has increased about over 400% 6-month inventory shift from March 2022 to September 2022. So huge increase in inventory. Boise City, almost 300%. And they're showing that as almost 80% overvalued. Austin is about 60% overvalued. Phoenix, about 55% overvalued, and a 300% increase in inventory. So huge increase in inventory. So reason why I want to point that out is because, again, this is super market specific. If you look at the Portland market, now this is well, it was, so this is August. The other numbers, they were looking at September versus March, but well, and I guess it could be a little deceptive. So I don't know exactly how they're measuring it, but you could say Portland has a, what is that, 250% increase from March, because it was 0.7 months of inventory. Now it's 1.8. But it's still very low. So you got to look at overall inventory too, not just the percentage of increase. But 1.8 months in the Portland metro area, that's still very low. And actually, I was surprised to see it go down. It was trending up a little bit, and I fully expected August would be, mid twos or something like that. It'll be interesting to see in a week or so here when the September numbers come out what that ends up being. But I think it'll tick up a little bit, but still 1.8 months of inventory is very little. Again, if you're comparing it versus March, that looks like a 250% increase. So you do have to look at what actually the current inventory is, not just, if it was very low, just like we've been talking about with year-over-year numbers and all that stuff being really down, it's because last year was crazy. And so year-over-year numbers are going to look bad for sales and all of that stuff. So that's the update to this week. I'm gonna keep getting better, I promise. I'm gonna figure out more of the screen share stuff, and so I can show you things in more detail. And I'll mix it up with how I do it. I just want to make sure you get the information and get it in front of you. Stay on top of what's going on in the market. One quick thing that I do want to mention too is that it's a really good time if you're looking at. You still want to buy, because whether you're looking for your residence or you're looking for an investment property, it is a great time to ask for a seller credit to buy down your interest rate. Sellers understand interest rates are very high. Affordability, they're not actually very high historically, but a lot, we're all in shock of what they were compared to what they were last, 6 months ago. They're high and have really made a huge difference in affordability and payments. So it is a great time to ask for a seller credit. Ask for a seller credit to buy down your interest rate, get it back down into, the 5.5% range. It takes a lot of money to do that, but you can do that, and you can ask sellers to help you with that. Another option is to start looking at, there's some great ARM products out there. I'm not a lender, okay, so I can't speak to the terms of those and all that stuff, but I know you can get in a much better rate than you can with your fixed term interest rates. And just give yourself a long, I don't think there's not really that many short-term ARMs out there right now. Most of them are 5, 7, 10 years. Give yourself a long enough runway that where I'm not a fan of the short-term ARMs. I think the long-term ARMs are a great option for the right scenario. Give yourself a long enough runway for the market to come back, in a cycle, and for interest rates to come back down, where you can lock in and refinance to a fixed term rate that's a little bit more reasonable. So anyway, that's my 2 cents for right now. There are still ways to get into the market. If you are looking to do that, I still am very bullish on real estate long term. I think it's one of the best, if not the best, ways to build wealth long term. You just got to go about it the right way, depending on what the market is doing. Don't stay out of the market. Just find a way to get into the market the right way and be strategic about it. Until next time, make it a great rest of the day.